All right. Good afternoon, everyone, and welcome to today's webinar. My name is Jorge Acosta Palmer, and I'm the director of the Statewide Training Initiative with Florida Legal Services. We're excited to have you join us today for student loan webinar. Before I introduce our speakers, I do want to go through some quick housekeeping announcements. This training is being recorded, so if you registered, you're going to receive a copy of the recording from Zoom within about 24 hours, but we will also be posting it on YouTube, so make sure to subscribe to our YouTube channel so you get notified whenever we post new videos. You can find some old webinars in our YouTube channel as well. And I'm going to drop my email in the chat just in case you have any issues accessing those recordings, so you know you can reach out to me. So the training was approved by the Florida Bar for 1.5 General CLE credits and 1.5 Business Litigation Certification credits. So I'll drop the CLE code towards the end in the chat. I will also read it out loud. That CLE code, it will also be included in the email that goes out from Zoom, and it will also be included in the description in the YouTube post. So the slides will also be included in the materials that will go out in the email from Zoom, and the link will also be included in the YouTube description. Closed captions are enabled for anybody who needs them, so if you're having any issues with accessibility, feel free to reach out to me directly. This training is being co-hosted by the Public Interest Law section of the Florida Bar, or PILS. If you're not familiar with PILS, make sure to take a look at their website, whether you're a private attorney, a legal aid attorney, a law student. We have different membership fees, particularly for law students. It's free for law students. It's a great opportunity for private attorneys to work with the legal aid community in areas of public interest. We have a consumer tenant work group where student loans actually come up quite often. It's one of those hot topics that we always discuss. So make sure to take a look at the public interest law section website. I'll be dropping the link in the chat, and it will also be included in the materials. And final piece of housekeeping announcements are questions and answers. If you have questions during the presentation, I'm going to ask you to use the Q&A feature. You can also use the chat, but the Q&A feature is a little bit better because it helps us track, and our speakers might be able to answer your questions as they come in. If for whatever reason we miss out on a question and we don't answer it during the presentation, we'll make sure to address any question that we may have missed towards the end. So with all that said, I'm going to go ahead and introduce our speakers today, but I'm going to pass it over to Jailene Vivanco first. So Jailene, the floor is yours.
Everybody, my name is Jalen Vivanco. I am Pat's paraplanner, and I am a recent graduate working my way towards the CFP and taking the exam. I just wanted everybody to know I am a Spanish speaker. I speak it, write it, and read it. So we do deal with that all the time. So if somebody's more comfortable in speaking in Spanish or a mix of both or English, whatever it is, we're happy to accommodate. And and I'll pass it over so they can introduce Pat.
Thanks, Jan. Thanks, Jorge. My name is Pat Logue. I'm a fee-only certified financial planner. I'm also a certified student loan professional. I'm based here in Naples, Florida. I've been working with attorneys in Florida for the past about 7 years or so. Student loans is one of the main topics. I think this group is uniquely positioned. Mostly you're working for public sectors, nonprofits, or government entities, I'm assuming. I'm assuming you're mostly working towards PSLF. If you want to put it in the chat, are you yes or no, are you working towards PSLF? Do you even know what PSLF is? Just pop that in there so we have an idea as we start this, like where are you at in your knowledge of student loans, and where are you going to be at the end of this seminar? We hope to provide you some just good free information here to help guide you. Keep in mind, anything we say here is not to be construed as financial advice. This is just free general information. We're happy to give you all the latest updates and help you use that to help you, maybe save some money on your student loans and, potentially either pay less, get out of debt quicker, or a combination of both. So, if you're working towards PSLF, some of the things you want to be thinking of as we're starting this webinar off is, are you working towards PSLF? Yes or no? What payment plan are you on? So we're going to use some terms out there. IDR, you're going to hear IDR, IBR. Some people use those interchangeably. IDR is income-driven repayment plans. That's a generic term, broad encompassing term there are 5 income-driven repayment plans. There's ICR. There's 2, not to be confusing, but there's IBR 2009, IBR 2014, very different plans. pay as you earn, and then repay, which became the save plan, which has been eliminated. So we really only have 4 options now. But just so you know, when we're using those terms, we just want to be clear about what we're talking about. And then when you're thinking about PSLF also, I'm hoping if you either have this information or we're hoping to help you know what information to look for. You should know your PSLF eligible payment count. You should also know how many PSLF payments are qualified. You should know if your employer is an eligible PSLF employer and how to find that information. If not, we're going to kind of give you some of that here. But you should have already filled out, you should be familiar with your ECF, Employment Certification Form. Some people think, do I just wait to the end of the 10 years and then complete everything? No. We recommend you complete it. I would, maybe wait to the end of your first year of employment, complete your ECF annually. You're going to need to recertify your income annually on a income-driven repayment plan. You may as well complete your ECF annually just to recertify and get caught up with your payment count. This is just a disclosure. I'm a registered Prudent Financial Planning is a registered investment advisor offering advisory services in the state of Florida. In other jurisdictions, we're registered exempt from registration. Advisory services are only offered to clients or prospective clients where PFP and its representatives are properly registered or exempt from registration. The information in this presentation is for informational purposes only and does not constitute individual advice or guarantee that you'll achieve a desired result. As attorneys, I'm sure you can all appreciate that. We have to add that in for compliance purposes. So what we do, we work on helping clients navigate student loans and financial planning, or just student loans by themselves. So like I mentioned, I'm a certified student loan professional. I have over 25 years of financial services experience. I'm a certified financial planner, CSLP, and I'm passionate about helping you with your student loan debt. So as a CSLP, this is designation that just started a few years ago. But in order to achieve this, you have to have at least 2 years of financial planning experience, be a licensed financial professional. That we had to go through a certificate coursework and take an exam. Why is student loan debt important? There's about 1.8 trillion in U.S. student loan debt, and that's continuing to grow. There's about 43 million student loan borrowers, and average debt's about 30,000. If you're an attorney, though, that might be closer to 200,000-300,000, depending on where you went to school and whether or not you took undergrad loans out or not. What can you do about your student loan? So option 1, you can call your loan servicer. On the loan servicer website and all their communications, it will say, caution, be aware of scams. You don't have to pay anyone to help you with your student loans, and you don't have to pay anybody. You can just do it all on your own. But I would just maybe direct you to a lot of the student loan lawsuits against these loan servicers. And then there's a reason they keep changing loan servicers. They get rid of ones that had too many complaints, in my opinion, and they bring on new ones and try to correct the problems. You can even try, I'm sure you've seen some of the hassles. You'll call your loan servicer. You might get 3 different answers if you call 3 different times. So it's difficult to navigate, but you can definitely do it. DIY is an option. You'll navigate all the changing plans, options, and rules by yourself. It takes a lot of time. You're probably busy helping other people with their legal issues to stop and really focus on this. And if you miss this, as we're going to discuss in this webinar, if you wait and wait and wait, like I see a lot of people do with student loans, you might miss out on some potential benefits, right? I'm not trying to scare anyone. I'm just giving you the facts that there are some potentially large changes coming down the pike. July 1st of this year is the date, and I'll show you some of the legalese and the things that should be or we expect to be becoming enacted at that point or before then. Option 3, you can work with the CSLP. It doesn't have to be me. You can look at just Google search, find a CSLP. You can find someone who specializes in student loan planning and work with them to get an idea. Typically for a student loan analysis, like I charge something like $495. We give discounts. My student loan service is a member benefit for all members of the Florida Bar. You get a 10% discount on a student loan plan. So those are things that we offer if anyone needs individual help. My goal is just to give everyone as much information as they can here that you can maybe start affecting some changes on your own. So timing, the regulations from the One Big Beautiful Bill should take effect by July 1st, and there are also several changes taking place after that point. The income-driven repayment plan, so I mentioned IDR. Keep in mind that just income-driven repayment plans, it's a generic term that is not a specific plan. There are 2 IBR plans, ICR and Pay. Pay as you earn, right now, this is the plan that I think this is the hottest plan to be talking about right now. This is a plan that they talked about getting rid of. They're going to keep it right now, I think. If you get on it before, and this is all take this with a grain of salt. I can't confirm that this is actual fact, but I believe If you're a current borrower and you're paying towards your loans, you get on pay as you earn before July 1st. I think you should be able to stay on it. Now, that comes with a caveat. That's assuming they don't change something else down the road. That's also assuming that you recertify annually. If you don't recertify on time, you could be kicked off the plan, and I don't know if you'll be allowed back on it. Now, why is that important? This plan takes you, there's some calculations we can go through later, but you take your adjusted gross income. This will be line 11, I believe, of your 1040 on your personal tax return. Adjusted gross income. Let's say you make $100,000 a year. The calculation starts with adjusted gross income. So you make 100,000, you get a deduction for the poverty level for your family size. And you're probably familiar with this. Some of you are working for legal clinics. That poverty level for one individual is about $15,000. You get a deduction. Let's just say you're single. You get a deduction for 150% of that poverty level. So about 22,000. So 100,000 in AGI minus that 22,000, you've got discretionary income of 78,000. They'll charge you 10% of your discretionary income. So $7,800 per year, divide that by 12 months, about $650 a month. That's a good plan. You only pay for 20 years, and then your loans should be, and I'm going to use a caveat, should be forgiven at the end of that period. I can't say what they're going to do with these plans and if they're going to offer forgiveness or something else doesn't change between now and then. But that's important because some of these other plans, it might be 25 years till forgiveness, and you might pay like one of the IBR plans, you pay 15% of discretionary income. The other one is only 10%. One is 25 years long. The other one's 20 years. ICR, you only get 100% deduction of the poverty level, and you pay 25% for, or 15%, I'm sorry, for 25 years. So, or that's, I'm sorry, ICR is 20%. There's also a less often used calculation for ICR that may benefit borrowers that have high income and low student loan balances, but that's pretty rare that that works. So these are the payment plans we're going to discuss. And like I said, IBR, be ready because there are two different IBR plans. So when we talk about student loans as a financial planner, I'd just be remiss if we don't look at what are we talking about when we're trying to, what are we trying to accomplish with our student loans? Will your net worth grow faster if you pay, like, let's say you have $100,000 in student loan debt, if over time you pay $150,000, or if you paid $250,000 over a certain period of time, or if you only paid something like $60,000 or $70,000? I mean, the answer is pretty intuitive. The less you pay, most likely, the faster your net worth could potentially grow. Those are things you need to consider when working towards paying off your student loan debt. Other factors could be, do you need to improve your short-term cash flow? Maybe you're just out of school, getting married, starting a family, buying a house. Do you need to keep that payment low right now? Or is it more beneficial for you? Are you just trying to pay off your loans quickly? Some of the things you just want to consider when you're looking at your student loan debt. So some considerations, if you get married or you are married, some things to consider. Do you both have student loans? Are they both federal loans? Do one of you have private? One has federal, combination of both. If you both have federal loans, it gets a little complex how you should proceed. It's going to be a little more of an in-depth calculation. You're going to look at your individual incomes. You're going to look at your total student loan balances. For example, let's just say you're making $200,000 combined. Let's just say your combined payment is supposed to be, I don't know, we'll say $1,500 a month on whatever plan. If you each have $200,000 in student loan debt, you each have 50% of the balance, then you each owe 50% of that $1,500 payment, $750 each. If one person has twice as much in student loan debt as the other, their payment's going to be twice as much per month as the other spouse. So things to calculate, things to consider. Other things that we might not consider here in Florida, sometimes we don't look at, should you file married filing separate or married filing joint? We're not in a community property state. There are only 9 of those. You're probably very well aware of those in the legal field. And then are you working towards PSLF? Now, working towards PSLF, I don't know if you realize, but what do you think the goal is? Do you think the goal is to, pay your loans off the quickest possible? Should you pay off all of the interest every month? Or are you trying to pay the least amount possible? What answers? Let's see if anyone puts any answers in the chat, and maybe Jorge, you can let me know what you're seeing in there. But just once again, with PSLF, do you think your goal is to pay it off quicker? If you're on PSLF, should you also be paying at least the minimum interest? Do you care if your loan balance grows or not, or do you just want to pay the least amount possible? What's
Yeah,
that?
what I see so far is, and I agree, it's just pay the least amount possible.
Great. Yeah, that's the goal. So now if you want to pay the least amount possible, let's say you and your spouse have income parity, your incomes are fairly close to one another. If all else being equal from a tax filing standpoint, do you think it's beneficial to file married filing separate or married filing joint? let's see if anyone has any insight on that before I give away the answer.
Yeah, we have one answer, but I don't want to give it away to make sure other people answer. I mean, they're going to see the answer, but I guess I'll mention it. The answer that I see in the chat is separate.
Okay. Yeah. So it's going to depend. This is very highly independent of your individual situation, your tax situation. But if all else being equal, if the tax liability were the same between married filing separate, married filing joint, it's going to benefit you more to file married filing separate because now your student loan payment will only be based on your income, not your combined income. So if you're both making 100,000, for example, only one spouse has student loans, either you're going to file married filing joint and your student loan payment is going to be based off of $200,000 in income, or you file separate and now your payment's only based off of that $100,000 in adjusted gross income. Does that all make sense? Anyone have any questions on that particular issue? And like I said, it's highly individual. You have to run some specific calculations with your accountant. Keep in mind, I have 2 years of tax prep experience myself. I'm not a CPA, but I've done tax prep. Accountants are trained to get you the lowest tax liability possible. We see this all the time. Clients will just go to or someone will come to us and say, hey, you mentioned in a webinar that I should do married filing separate. I reached out to my accountant and he said no. Well, that's really not enough information for me to go off of, but I see this over and over and over again. Well, if you just go to your accountant and say, what's better, married filing separate or married filing joint? They're trained to find you the lowest tax liability. You didn't give them any more information. So they just went and said, okay, let's say married filing joint, your tax or married filing separate, you're going to pay $500 more. I'm just going to throw a random number out there. $500 more that year in tax liability. Well, your accountant doesn't want you to pay $500 more. So they're going to obviously defer to having you pay the least amount tax. Now, if you went to them and said, hey, if I paid $500 more in tax by filing married filing separate, I've run some calculations and I think I'll save, let's just say it's going to be $5,000 in student loan payments over the next 12 months. Well, that's a much different conversation that you're having now. Okay, in that case, it probably would make sense for you to file married filing separate. And keep in mind, there are nuances with married filing separate you have to be aware of, such as you most likely won't be able to contribute directly to an IRA or a Roth IRA. You might lose some tax credits, such as the American Opportunity Tax Credit, Lifetime Learning Credit. That's not an exhaustive list. Consult with your accountant if you're ever going to file that way. Make sure you know the exact difference between those two. But in a very simplistic world, that would make great sense, right? To pay $500 more in tax to save $5,000 a year in student loans. And you're correct with the PSLF, you want to pay the least amount possible because that loan balance can keep growing over let's say it's 10 years, you have to make payments, 120 months. You can let that balance grow because whatever's forgiven should be, and I'm going to use should in all these examples. I think I'm doing my best legal interpretation of covering myself here, but you should most likely have that forgiven tax-free with PSLF, right? So you don't care how much that loan balance grows. Of course, it's not going to feel great over those 10 years to see your loan balance growing, right? And if you don't complete the 10 years, you're going to be behind the curve and paying your loans off. But that's part of the trade-off of PSLF. And then consideration 3, buying a house. How do student loans affect your mortgage? Well, this is a great question. We see this all the time. Clients might, for example, let's say you have a couple $100,000 in student loan debt, you refinance your student loans, and now your payments, let's say $2,300 a month for the next 10 years. Then you decide to go apply for a mortgage. Well, that student loan refinance might have just messed up your debt to income ratio. You might not qualify for, whatever that mortgage might be. It's gonna make it harder to qualify for that mortgage. So if you could have been on PSLF, married filing separate, you're on one of the income-driven repayment plans, and you just started your job, you're, let's say 50, 60,000 a year, your payment could have been $400 or $500 a month, as opposed to 2,200 a month. And maybe that would have helped you, qualify for that mortgage. Also, you want to look into things, make sure you're not getting out over your skis. As Jorge and I were just talking about skiing a little earlier, but you don't want to get out over your skis and say, okay, I want to keep my student loan payment as low right now so I can qualify for this big mortgage. But then what happens in 6, 12, 24 months, you refinance. Now you do have that $2,500, $2,200 payment for student loans. So keep that in mind. You don't want to take on, more than you can chew when you're buying a house and you have student loans, but they definitely are correlated. So as I mentioned, the student loan payments, they affect your debt to income ratio. So make sure your payment's listed correctly when the bank runs your credit check. So there are 3 ways a bank will look at. Different banks are different. There's no way of knowing before going in, and as far as I know, how they're going to look at it. But some banks will look at your student loan payment. And when we were in the COVID forbearance, a lot of you had $0 payment. So that they could have looked at your payment and said, okay, we're going to assume your student loan payment's zero. Okay, therefore you can qualify for more mortgage. That could be good, that could be bad. Some banks are going to say, well, we're not going to use that $0 payment. We're going to look at if you owe, let's say, $200,000, we're going to take 1% of that and say $2,000 is your monthly payment. So they could have looked at that. That will most likely not allow you to qualify for as much of a mortgage, right? And the third way is some banks just will exclude the student loan payment and say we're not going to count that. And then credit score. So improving your credit score from 670 to 800 could help you save about, this is just rough math, about $60,000 on a $300,000 30-year mortgage. I mean, I can show you all the math and everything, but just understand that you really want to improve your credit score before applying for a mortgage. Just a little something I wanted to throw in there. And then know the loan types, down payment, all that stuff. If you ever want to compare your credit score to see like what type of mortgage rate you might get, this is a link. You can always pull it up later, but what type of mortgage you might get with that certain rate. And this is just the math to show you that you might pay $180,000 in interest here. You might only pay $120,000 in interest here. Keep in mind, these are very simplistic calculations, assuming you pay minimum payments over the entire 30 years of a mortgage. So let's get into a case study here. Do we have any questions popping up in the chat or Q&A that I need to stop for?
Let me double check. There was one question earlier that Aline answered, but it's a really important question that I want to kind of make sure I put out there for everybody to hear. And it's related to public service loan forgiveness. And the question is, can I go back in time to start requesting credits for those payments while I was working for a nonprofit or for government?
Yeah, that's a great question. Yeah, so as long as you met the requirements, you had to have been working for an eligible, a PSLF eligible entity. That's part one. And you can always go to the PSLF help tool. Oh, you can Google that. You can do this on your own if you need to. PSLF help tool. Make sure that entity was qualified. Make sure you were an actual employee of that entity. You cannot have been an independent contractor working for an entity in most cases. There are some exceptions for hospitals in California and Texas, I believe. I don't know if there are any others yet. And then you want to make sure you were full-time. Full-time now is, I don't know how they look back, but now it's defined as at least 30 hours per week. It used to be 40 hours per week, but you can go back. And I believe PSLF started, I think, October 1st, 2007. So any work experience before that would not count. You need to have each month of qualified work experience. And this is where you get into whether your payment's PSLF eligible or PSLF qualified, right? So you're eligible if you worked for a qualifying employer, you were an actual W-2 employee of that entity, and you were full-time. Those are, there are other, just make sure you check all the boxes. That makes that month eligible. It becomes qualified if you at the same time were in a qualified payment plan making payments. And don't read too literally into that, because we had the account adjustment. If you consolidated your loans before June 30th, 2024, there's TE, temporary expanded PSLF. There's a bunch of different things that could help. Don't be scared off by the fact that maybe your loans were if your loans were in forbearance or you had a $0 payment. Those periods of time might have counted. I'm going to say maybe. Those are things we can help you navigate if you want to, but you can go back in time. You'll go to the PSLF help tool. You'll look up your eligible entity. You'll enter your work dates. Now, keep in mind, when you're entering those work dates, you want to be as specific as possible. Don't just guess it was around June 30th of 2016 to whatever. No, that could throw off the calculations. You're going to want to try to find your exact start date and end date, and you're going to need an email address for someone in HR at that entity. And nowadays, you can do everything. You used to have to get a physical form. I'm sure people remember this. You'd have to fax it to them, and we don't have to do that anymore if you don't want to. You can do it electronically right through the student aid. That's the Department of Education website. They'll electronically send that authorization to that email address to be approved. It's going to take them some time to approve it. So if you're going back in time trying to get credit for previous months, gather all that information. Any job you worked that was a nonprofit, could be a government entity, could be federal, state, local, could be tribal. We've helped people with work towards PSLF that were working for tribal entities. You can try to get any of that experience possible, and you want to make sure you'll get your EIN number if you have an old W-2, or you can typically Google search an EIN for an entity. It's the employment identification number. You're going to want to need that number. You're going to want to enter that in the PSLF help tool. Now, be careful. The number is usually, I think it's a 9-digit number. It's 2 numbers, then a dash, and then 7 numbers. The dash does not get included on the PLSF help tool. So typically some people enter the dash and the last number gets cut off and it'll say not eligible. Make sure you've got all those, all the numbers are in there. Make sure that that is complete. We've seen that lead to some errors. Any other follow-up on that one?
No other comments on that one. I also checked the Q&A and there are no pending questions right now. Thanks, Pat.
Okay, great. Yeah, so we'll jump into kind of more of a case study. So if you're working for a nonprofit, a government entity, let's just say your income is about $80,000, you have $300,000 in student loan debt. We'll look at single versus married, and we'll look at some various solutions here. And pop in questions or raise your hand if you have some questions you want to stop during this. I don't want anyone to get lost along the way, and I'd love to clarify if I need to. So this is an example of a borrower has $80,000 in income. This is I'm using adjusted gross income, line 11 of your 1040. So I'm assuming the borrower qualifies for the following payment plans: ICR, pay as you earn, or the new IBR, which is IBR 2014, which is the better of the two plans. So of these, we're not going to use ICR. We're going to use pay or the new IBR. Your income's $80,000. The deduction for being single, it's actually higher than this now. It's about $22,000. I think I just did this with an old calculation. But this would bring your discretionary income down to $62,000 in this case. 10% on the pay-as-you-earn plan or new IBR, you're going to pay 10% of that discretionary income. So that's $6,200 a year. They divide that by 12 to get a monthly payment of $517. So that's if you just do nothing except you just sign up for, let's just say it's pay as you earn. You're going to pay $517 a month. You're going to pay $6,200 a year. Let's assume your income is going to go up, some kind of level, 2-3% per year, right? Maybe you're going to pay a little more per year, but at this rate, you're looking at paying about what, 6,200 times 10 years, 62,000, maybe 72,000, just ballpark if your income gradually increases over time. We expect that deduction will go up over time as well. So, right, that's much better than taking a $300,000 loan. We know, for example, if you take a $300,000 loan and try to pay it at about 6% interest and pay it off over 10 years, you're going to pay about, call it $3,300 a month. So close to $40,000 a year. That's going to cost you $400,000 over 10 years. That keep in mind, I'm just doing back of the napkin math, but to give you an idea, significant savings. And we're assuming that the forgiveness on PSLF is tax-free, right? We're running with all these assumptions as we know things to be today. So what happens to your payment now if the borrower contributes? You can contribute for this year, for 2026, up to $24,500 to, let's say you have a 403B. So we'll see this a lot with, hospitals, nonprofits have 403Bs instead of a 401k. You may also have a 457. This is a deferred comp plan. So I'm just going to assume, like we've seen this with policemen, police officers, firefighters. They might have a 403B and a 457. You may have this as attorneys as well, but I'm just going to show you like the best case scenario, right? You may only be able to contribute to one, right? If you can only contribute to a 403B, maybe it's only 24,500. These numbers would be a little bit different. This is just going to show you that your income starts at 80,000 if you can max out both of those, right? And these are two plans that you don't aggregate this. There's a $24,000 annual elective deferral limit, 24,500. This applies in aggregate to all 403Bs, 401ks, and TSP plans. So those would all be aggregate. Like if you had a 403B at one job and a 401k at another job, you could only contribute 24,500 between the two. The 457 is separate. It's by itself. It has its own separate annual elective deferral limit. That's just why I'm showing you this. And in this case, your income's 80,000. You're making these contributions. So you contribute 49,000 to your 403B and 457 split up. These are all going to be pre-tax contributions. These are not going to be Roth contributions. The pre-tax contribution will reduce your AGI. Now you're single, and I updated that. The discount amount's 22,000. Your discretionary income is only 9,000. Now, right? Can you really afford to do that, right? If you're single, you can't live off of if you're taking 80,000, you can't afford to put 49,000 into retirement plans in most cases, right? But just to show you how low the discretionary income can go, annual payments 900, monthly payments 75. Not very feasible for most people, but this goes to the case of what if you're married and both of you have incomes of 80,000, only one spouse has loans, you file married filing separate, and this borrower, the borrower with the loan, or the spouse with the loans could maybe max out both of these plans, and this spouse maybe contributes the bare minimum to their retirement plan, right? So we're getting into different scenarios and getting into the weeds on ways where we can really drive the payment down as much as possible. And keep in mind, like I said, this might not be available to you. Maybe you can only do 20,000 to your 403B or 457 or 10,000. Either way, you're gonna drive down that AGI and drive down that payment. And then if you're doing that, if you're contributing $49,000, let's say you can contribute that much, over the 10-year period when you're working towards PSLF, you will have contributed $490,000 to your retirement accounts. Now, I'm not going to get into how much that's going to earn, right? You're going to invest that money. It's going to have some kind of a return. I'm not here to talk about it. It's just not prudent for me. I like prudent, throwing a plug for myself. It's not prudent for me to project any kind of returns. So I just want to give you apples to apples comparison, right? If you're paying $3,300 a month towards your loans on a 10-year payment plan, you're probably not putting a lot in your 401k for that first 10 years. As opposed to a strategy like this, whatever you can put into your 401k or 403b, you're going to potentially contribute more to retirement, pay less towards student loans. That's what we're trying to get at here. Now, let's say you're married and have 2 kids. The spouse with the loans earns 100,000, and the spouse with no loans earns 50,000. So we're saying the one spouse has no loans, and assuming you're qualifying for these same payment plans, your combined income is $150,000. The 150% of the poverty level for a family size of 4 is 48,000. So that's your discount. And your discretionary income in this case is $102,000. So in this case, you're going to pay $850 a month towards your loans if you didn't make any changes or do anything, right? Now, what happens if we use that same scenario, but now we say you're going to file married filings separate, and I'm not going to get into what the tax liability difference is or isn't. You have to speak with your own CPA and figure that out. You know, the enhanced child tax credit or dependent care credits might be different for younger kids. You have to always consult with your own financial professional. But in this case, if we're looking at this in a bubble of just student loans, the married filing separate borrower now, their AGI is only their own individual AGI. You don't add in the spouse because they're married filing separate. So they're starting at 100,000. They're going to max out those 2 retirement plans we talked about. So that's 49,000 into those plans, which reduces their AGI. Now they're married. This is family size of 3 only because they're not counting the spouse anymore. It's married, and this spouse, we're assuming they're claiming the 2 kids on their tax return. We're just making some assumptions here. But in this case, this drives your discretionary income down to 12,000, and your monthly payment is $100 a month. We're going to get, we could get into the discussion about, could you really afford to put 49,000 a year into your 401, your 403B and 457? I don't know the answer to that, but this is best case scenario, right? What if you only did 24,000? Okay, maybe your payment would be a few $100 a month as opposed to $850 a month, right? So is everybody on board that we're using? These are all, not numbers I don't want you to take this to the bank and be like, oh, you said I could do this, you said I could do that. These are very individual situations. Everyone has to consult with their own financial professional. And these are best case scenarios if you could even do this, but it gives us an idea that you don't have to be stuck paying that $850 a month just because you're married and your joint income's $150,000. Does that make sense to everybody? I should actually say, if it doesn't make sense, please speak up now and I'll make sure to clarify that. So, and in this case, once again, like if you could put that much in your retirement accounts, yes, you're saving $490,000 to those retirement accounts over 10 years. You're driving down the cost of your student loans immensely. And like I said, maybe you can only do some of this, not all of this. In PSLF, like I mentioned, you must work for an eligible employer. You can use the PSLF help tool to check that. And there's a PSLF search tool. You can search for your employer to see if they're eligible. You must be on an eligible payment plan, such as one of the income-driven repayment plans, or the standard 10-year plan actually counts. You wouldn't use the standard 10-year plan for 10 years because you wouldn't derive any benefit, right? You just pay off your loans in 10 years and nothing happened, right? You didn't get any benefit. But let's say you get to you have 3 months left and you don't qualify for any other plan anymore. Your income's too high or something is different. You just make the standard payment for the last 3-4 payments, whatever that is. And that should still count. And like I said, I'm gonna keep using the term should. You need to make 120 monthly payments while concurrently working for an eligible employer. They don't have to be in a row. They don't have to all be with the same employer. You can look back. You can get credit for prior work experience potentially. For more rules, if you want the exact rules, you go to studentaid.gov and go to the PSLF help tool. And is that all? Nope. We talked about how to reduce the total cost of PSLF, which is very important.
Very a good question.
Oh yeah, we have a question. Go ahead. Someone just asked, sorry, does the pay
Yeah, so
plan
we had a
count?
question in the chat.
Is
Does
that
the
the one?
pay plan count as an eligible payment plan?
Yes, as of right now, the pay plan counts. Like I said, with this one big beautiful bill, we're going to get into this. That's a great question. I'm going to use it should count. As of right now, it should be an eligible payment plan. There are some weird things going on with the pay plan. They were, like I said, they were trying to get rid of that. They were trying to get rid of pay, ICR, and the save plan all at the same time. I think they're just getting rid of save. Pay, like I said, it's tricky if you qualify for that plan. And that plan, keep in mind that people sometimes wonder, how do I know what plan I qualify for? It's all based on loan disbursement dates. It's not based on I have this, I have that, my income's this or whatever. It's just you cannot have any loans before October 1st, 2007, and you have to have loans after October 1st, 2011 to qualify for pay as you earn. So that is one of the weird ones. IBR, the newer, better IBR, you can't have had any loans before July 1st, 2014. So we have to look at, and there are weird exceptions where if you had a loan before one of those dates, but you paid that loan in full before you took out a loan, the next loan, maybe you qualify, just to give you the caveat. But as of right now, pay as you earn should qualify. And I'm imagining, I mean, I guess if we could ask, I bet a lot of you are sitting in save right now. You probably moved to the save plan, trying to pay the least amount possible. We'll get into that a little bit more. But if that happened, yeah, you had no payment, no interest was accruing. Those payments were not counting towards PSLF. And as of August last year, August 1st last year, I believe, interest started accruing again. So if you're sitting on save right now with no payment, just understand that interest is accruing and you're not getting credit towards PSLF. So what can you do? We'll get into that, but there is a program called the PSLF buyback. It's a murky gray area. If you really want my honest opinion, that's just my opinion. We have clients from this group that have reached what we believe is 120 months of qualified payments. We have helped them apply for the PSLF buyback, and we're just waiting to hear back. How does the PSLF buyback work? Let's say right now, the only way you can qualify at this time that I'm aware of, if you believe you should have already reached 120 months of payment history or qualified months for PSLF, if not for the time you spent in save. Let's say you're on save, let's just use a round number, 20 months, you were sitting in save with no payment. And had you been making your payments, you would have reached 120 months and you think your loan should be forgiven now. If that's the case, you have to get everything all lined up. You have to show that you have 120 months of eligible work experience. You can apply for the buyback, and what they are supposed to do is calculate the lowest payment you could have had on an eligible payment plan for those 20 months. So save doesn't exist. They'll probably have to look at pay or IBR, the old IBR, ICR, whichever plan you qualified for. They would use whatever that income was that you were using at that time to verify your payment, and they'll give you a bet. They're supposed to give you a buyback amount. I think we've had two clients actually get their loans forgiven through the buyback, but I don't think they ever got a buyback payment amount. They just got their loans forgiven. The system's been weird. But for example, let's just say your payment should have been, I don't know, $100 a month and you had 20 payments. They're going to say, if you make a payment of $2,000 now, you get credit for those 20 months and then your loan should be forgiven. Now, we'll get into this a little bit more, but the Department of Education right now, they're currently every month they provide us with a status report because of a lawsuit from the Teachers Federation that just said they were sick and tired of the Department of Education not processing anything. They just stopped processing IDR applications. They stopped processing consolidation loans, forgiveness. So they have to provide a progress report every month. Their most recent report, I think they still have something like, don't quote me on this, we can look it up, but about 700,000 income-driven repayment plan requests outstanding. I think in the prior month they had processed 70,000 maybe, but they received 50,000 new ones. So at this pace, it's going to take them about 3 years to process that. For PSLF, I think they had something like I don't know, what's like 30 to 50,000 applications, and I don't even know how many buybacks. So it's something, if you want to work on it, I would work on it sooner rather than later. There is talk that this buyback might be extended to anyone on any income-driven repayment plan in the future, which I would hope, because borrowers have just been sitting here with no payment. Now, if you're on save right now, you've got some really big decisions to make, right? If you're working towards PSLF, let's just say you're only 5 years in or something like that. Do you stay on save and keep a $0 payment, but let your interest keep growing? in the hopes that in the future they allow you to buy back these months at whatever rate that's going to be, right? Or do you B, switch to a payment plan now and start getting back on track and paying because most likely your income is going to keep increasing over time, right? So these payments now will probably be lower than anything in the future, right? So do you either pay now or tack on, let's say you have 5 more years left, you'd have to make, let's say you either make it a year of payments now and get going, or you make a year of payments at the end of 5 years, right? When your income might be, maybe it goes from 60 grand to 80 grand at that point. So you have to make that decision. The other consideration is if you're eligible for pay, if you're not eligible for IBR 2014, the new IBR, that's another one that's 10% of discretionary income. And that's what you want when you're on PSLF. You don't want to pay a higher amount. Do you apply for pay now so you have that 10% of discretionary income and maybe that would stick around? Or do you wait? They're supposed to come out with a new plan after July 1st, the WRAP plan, which will be 10%, but keep in mind, it's going to be 10% of your adjusted gross income. There's no discount in calculation to reach your discretionary income. It's just 10% of your adjusted gross income, which, as we can see, if you have a family size of 2, 3, 4, 5, that payment's going to be higher on RAP most likely. Now, they're supposed to have some kind of deduction. It might be $25 a month per dependent on that WRAP plan, but we'll have to wait and see. So you have some really big decisions to make if you're working towards PSLF, stuck on save right now, but we can get into that. We kind of did the comparisons here. So if there's any other questions on that, feel free to throw that in, but we will get into that a little more. But in the first scenario we showed where your payment was $850 a month, we're going to assume that your income is going to grow about 2 to 3% per year. In the 20th year, let's say you're on a 20-year payment plan like the new IBR or pay as you earn, your payment might be $1,300 a month because your income keeps going higher. Over time, and including the amount you might pay in taxes on any amount forgiven, might be $290,000, right? So this is just in that example. This is not saying what you're going to pay or anyone else. This is just in that example. If we used something like pay as you earn, we filed married filing separate, we're assuming there's not much of a tax liability difference, and you work towards PSLF, you're able to maximize those retirement accounts and you drove your payment down to $100 a month, right? Maybe this isn't that likely for you, but just to show you, you might only pay $11,000 over 10 years. Now, that's going to be completely best case scenario. Don't know if your cash flow really supports it, but what if it's $400 a month? What are you paying? $40,000, just ballpark $50,000 instead of $290. PSLF can be a very helpful tool. There's also, I don't know if I mentioned, I consulted on the CARES Act in, was it December of 2019? I was approached by a think tank. They knew I was doing work on student loans and financial planning. They asked me if the COVID becomes a pandemic, should we either forgive $5,000 of student loan debt for all borrowers, forgive $10,000, have a lower payment, or something else? And I said something else. And they're like, what? They're like, we've already consulted a bunch of people and those are the 3 best options. We just wanted to see which one you liked. I'm like, no. I'm like, if you really want to help people, what I was thinking of people in your situation, right? Attorneys, medical professionals, you have sometimes $200,000-$300,000 or more in student loan debt. Forgiving $5,000 or $10,000 in debt during COVID wouldn't have done you much good, right? Your payment still, if you're on an income-driven payment plan, your payment would have been your payment. If you were trying to repay it on a 10-year payment plan, it wouldn't have changed that payment very much. Having a lower payment, that was kind of vague. I didn't know what that meant, and I didn't know if interest was going to accrue. Like you see with the save plan now, interest is accruing. I said, I recommend a $0 payment, and I said, and I don't quote me on that until I finish, but only if you're going to have no interest accruing during that time. Now, I didn't know if it was going to be 3 months. I definitely didn't know it was going to be 39 months of forbearance and no payment. But they went with that. They brought it to the administration and they said that's the best idea they've heard. We want 30 more ideas from you. So they went with that. That was Section 3513 of the CARES Act. If I know you're lawyers, you might want to fact check me on that. Go right ahead. This is an employer benefit program that I know I came up with because I'm a nerd. I had a family member who worked for Abbott Labs. I remember they had an IRS letter ruling that was something along the lines of if your employee is not making enough money, like they're paying money towards student loans or towards credit card debt and they can't contribute to the 401k, Abbott Labs still wanted to give them their 3% match. They didn't want them to miss out on that. So that was an IRS letter ruling that I was aware of. And I know some people have Section 127 or Section 132 tuition reimbursement plans. So if you're going to school, you can allow your employees up to $5,250 of their current income that would be tax-free towards a benefit like that. Now, this benefit I created is for people who've already graduated and have student loan debt. So not many people knew about this one because we had $0 payment for so long, right? No one really needed to worry about this, but this plan was just made. I think they made this permanent. It allows your employer to pay the employee up to $5,250 of their current income as tax-free income towards student loan debt. Yeah, it was just made permanent, and it's for if you're a small business owner, you can't own your own practice and do this for yourself. You can't derive more than 5% of the total benefit. But this is a helpful tool because if you get $5,250 tax-free, you're not paying federal tax on it, and you're not paying FICA tax. We don't have any state income tax here in Florida, but your employer is also not paying the FICA tax. So that saves them 7.65%. So it's a little over $300 per employee, saves you $300 in taxes that you can better use towards your student loans. And that can be used in conjunction with PSLF. And then if you want more help, this is just contact information, things like that. But I want to share another screen with you to kind of go through some of the regulations that are coming pretty soon. Do you have any questions on any of these other options we just went through?
Let me check the chat. There is one comment about the buyback. The comment is, I have been waiting since April 2025 for the buyback. You
April
did mention LRAP.
2025.
Yeah.
Well, I mean, I've had clients that got the buyback approved. I had a client who had their loans forgiven to December. She requested the buyback December. Oh, it was December of 24. April of 25, we had another client who got her loans forgiven through PSLF. Yeah, that might be right. I mean, you may want to, whoever that individual is, maybe reach out to the Department of Education again to see if they're processing that for you. For a long period of time, I want to say maybe from like March of last year through December, they weren't really processing much. So that it could be possible that it's been that long. But yeah, if it's been that long, just make sure you're following up with them.
And Pat, you mentioned LRAP, the Loan Repayment Assistance Program, and I'm gonna drop it in the chat just in case if anybody here works for civil legal aid, they should be familiar with the Florida bars. I guess at this point it would be funding Florida legal aid, the LRAP program. They usually have deadlines and announcements are made of when to apply. Not everybody's eligible, but definitely look at it. And if you are at an LSC organization, LSC also has an LRAP program, so it's kind of a great program to take advantage of if you work for civil legal aid or you work for an LLC program. It's just one of those opportunities that you want to take advantage of. I see one more comment here. Let's go ahead and read it out loud. It's, I had my request for repay denied, and the reasons they gave for denial did not make sense to me, especially that it was the least costly monthly payment. Is there a rule that you can't choose the least expensive repayment plan?
That's odd. So their request for what was denied? Repay
Yeah, repay.
for the plan, the REPAYE plan?
Yeah.
Yeah, that plan doesn't exist anymore.
And the follow-up is I applied in November or December of 2024. I got the denial in January 2025.
So repay, there's certain qualifications. Maybe you didn't qualify for the repay plan, but you should have been able to, that you should be able to see the lowest cost plan. So when you're applying for a payment plan on studentaid.gov, it'll show, okay, plans that you qualify for. Let's just say it shows like the old IBR or ICR, old IBR, new IBR. It'll show you what your projected monthly payment is, and it'll tell you, it should give you a reason why you don't qualify for certain plans. Repay, I'm trying to think, why wouldn't you qualify? Were you married filing separate? Because you couldn't use married filing separate on repay. That was one of the things.
No, the answer is no.
Okay, repay. So on repay, I'm wondering if your income might have been too high at that time. Some of these plans used to have a PFH, partial financial hardship, and we'll get into this. This actually brings us right into number 2 right here. The income-based repayment plan used to have a partial financial hardship, but they got rid of it. Well, they said they got rid of it. We've still seen some people have some issues trying to qualify for it. Like, let's say your income's $300,000 and you only have $100,000 in student loan debt. But you only have like 4 payments left. So you don't mind if your payment's high for the last few months, you just want to get done and get your loans forgiven. In those cases, now you should be able to qualify for these plans. And that individual, if you want to reach out to us, we offer anyone a free initial consultation. If you want just to talk about student loans. And just to be transparent, what we do is I listen to what you have going on. I can't give you any specific information unless you are an actual client, but I can tell you general terms, general things that you might have not have thought about. And if it seems like you need some further assistance, like I said, we do offer a student loan analysis. Like I said, it's $495, 10% discount, it's $445. With that student loan analysis, we'll gather all your student loan information, your family size, some basic income information, what type of retirement plans you have access to. Another thing you can contribute to drive your AGI down is like an FSA or an HSA. We didn't even get into that, but we'll talk about those things. And if it seems like you need one-on-one help, that might be something to do. And maybe there's just something you weren't looking at that we can help you navigate and get that payment low. But yeah, it's a shame that you didn't qualify for that because that plan turned into the SAVE plan. And but then the SAVE plan was it didn't last very long. So yeah, that's something if you want help, just feel free to reach out. Just email us, call the office to schedule a free initial consultation. And then this brings us to the RISE regulations and this group as attorneys. I think you'll be more aware of what we need to talk about here and the steps that need to happen. But I know these are things that have been, they had their summary hearings and then they had their open comment periods, and then it comes to this next thing, and then they approve this, they approve that. As far as I know, all this was approved to be part of that one big beautiful bill. But from what I've heard, there's still some legislative hurdles they have to clear before this is actually enacted. So I'm going to give you the information as I think these things should occur. This is what we've seen from these RISE regulations. And I'm going to tell you what I think is going to occur, but please keep in mind, I'm not telling you these are facts. I'm just telling you this is what I think might happen going forward. So it's called the Reimagining and Improving Student Education. If you want to look it up, we do have an attorney in the group who's kind of given us some of this information, and I think this is we can rely on it, but I wouldn't consider it guaranteed. But it's the discussion draft regulations under the one big beautiful bill, and it incorporates all 11 regulatory sections in the new loan limit provision. So the first provision they're talking about is the IBR, the applicable amount. It's 15% of AGI, and you get the 150% of the discretionary income amount. Now that's the old IBR is 15%. The new IBR is 10%. But the IBR, you should be able to elect it even without showing the partial financial hardship now. So that's important for the individual who couldn't qualify for repay. I don't know if you'd qualify for pay or for the new IBR, but be interesting to see. If it's greater than or equal to the standard payment, they'll recalculate it to the standard payment amount. So that's nice. So you can have higher income, but you gain no reduction. And let's see, servicers must verify income and family size annually. So that's an important part, especially if you're working towards PSLF and especially if you're going to try to use the pay as you earn plan. You have to verify your income annually. We didn't have to do that during COVID, so people kind of fell asleep a little bit on this. Don't fall asleep on this. If you have to today, log into your studentaid.gov account, find out your IDR anniversary, it's called your income driven repayment plan anniversary date. You need to know when you need to recertify, and I wouldn't wait until a day or two before it's due. I would do it a month before it's due because we want to make sure these things get processed. Now, new loan limits. So this is going to be if you know anyone who's going to start law school in the next year or two, this is going to be very important. This is going to change. I'm sure a lot of you sitting here today might have more than $200,000 in student loan debt. But in the future, starting July 1st, 2026, if this goes into effect, graduate study borrowers only be able to borrow $20,500 a year for aggregate limit of $100,000. Professional study would be $50,000 a year for a total of only $200,000. You can add in your undergrad loans as well. But professional study is what we're talking about. We're talking about fields such as medicine, dentistry, law, pharmacy, et cetera. So that's what we're talking about. That's going to be the new limit. New students or new law school students are going to be faced with the possibility of maxing out their federal student loans at $200,000 and then going and also borrowing another 50, 70, 100,000 private. And that's going to really make things very difficult for them. So things you're going to want to navigate in the future and let anybody know about that. And if you're not going towards one of these professional degrees, it's only limited to 100,000. So just be very careful what programs you're going into. Parent Plus loans, a lot of us in here now, we're taking out loans for our kids, right? I don't recommend Parent Plus loans. They're high interest rate. Going forward, if you have Parent Plus loans now, this is a huge time. I don't even know if there's enough time to get everything done, but potentially you could still benefit from an income-driven repayment plan with Parent Plus loans. You have to do what's called the double consolidation. You have to take like half your loans, consolidate them, half the other half consolidate, you wait, then you consolidate, you do double consolidate. You take your consolidated loans, consolidate those into one loan. May or may not still be working, but after July 1st, 2026, most likely Parent Plus loans, there'll be no income-driven repayment plans allowed. You'll just have to repay it back like a car payment or a mortgage, and that's going to hurt a lot of parents. So if you're thinking about taking out loans for your kids, I would seriously learn more about that and see where what happens when the dust settles with all of this. Transition rules, schools can set lower internal caps. That's just for each school, but that's more on schools. But graduate and professional loans, they may not allow those anymore after July 1st, 2026, unless you're already in that plan, then you'll keep the eligibility. So those are grad plus and professional plus loans. So be aware of that. Deferment, so unemployment and economic hardship deferments will disappear for loans first dispersed on or after July 1st, 2027. Earlier loans retain up to 3 years of those deferments, and this just encourages people to use an IDR instead of deferment or forbearance for relief. Forbearance will be limited to 9 months with any 24-month period. Older loans keep the renewable 1-year maximums. And they're just trying to stop people from these serial forbearance, which just keeps your loan balance growing over time. And it's just a nightmare for borrowers. And stop me if I'm going too fast on any of this, if you have any questions. But this will be, I'll try to provide this as well so you can see this. You can look this up online. I'm sure you'll know how to look this stuff up better than I would. The fixed repayment plan. So going into the future, there's only going to be 2 fixed payment plans, the current 10-year standard term, and then a new tiered standard plan. So just for instance, if you have less than $25,000 total in federal loans, you'll be on a 10-year plan, all the way up to, if you have over 100,000, it's a 25-year plan. Now this is a terrible idea from a financial planning standpoint, I think, just because you'll pay so much more interest over 25 years. When you run the numbers and compare it, yeah, the payment's lower than a 10-year plan, but you're going to pay so much more in interest because you're paying interest for 15 extra years. So just keep that in mind. And borrowers with both the pre and post 2026 loans might be able to unify them under the tiered standard plan. So they're supposed to introduce the new repayment assistance plan, the RAP plan that I just mentioned. It's progressive rates of 1 to 10%. I was saying 10% because many of you will end up at 10%. But if, for instance, if your income, I believe, is 40,000, let's just say you're single, your income's 40,000, you might only have to pay 4% of your AGI. And it's going to be a tiered system like that. We're going to wait for all the facts on this one. But if you have lower income, under $100,000, I think this might be a good plan for you on PSLF. This might be a good option. They are going to try to do $50 per dependent deduction, but forgiveness doesn't happen until 30 years if you're not working towards PSLF. So keep that in mind. They're talking about these legacy plans, IBR, Pay, ICR. They might close to new loans on July 2026, but existing borrowers may remain. Now, the weird thing about this is none of this is official. What I'm hearing now is they're going to vote on this and make this official June 30th, right? So if they make this official June 30th and you didn't know you're supposed to get on Pay by then, you're out. So that's why I'm suggesting maybe it might make sense to get on a plan like this now before it goes away. If it goes away, like I said, though, I can't steer you any which way without clear information. But if it were me, those are things I would be looking at because I wouldn't want to, miss out on a payment plan that can be much more beneficial for me. Sorry, I scrolled a little too far. This is just talking about removing of the payment cap. That will be eliminated. For RAP, married borrowers filing jointly, RAP payments are proportional to each spouse's share. Periods of deferment or forbearance do not count towards RAP forbearance. And automatic forgiveness applies once payments reach the 30-year threshold. Now, they're not saying that if you can do married filing separate, but I think you're supposed to be able to use married filing separate with RAP. But if you can't, that's another huge calculation that you have to make, right? Does it make more sense to use RAP with this $50 a month credit? What if your income's below, 50 or 60,000? What if you only have to pay 5 or 6% of discretionary income? There's gonna be a lot of math to run when you're running these new calculations. For loans made on or after July 1st, 2026, you're only gonna be able to use the standard, the tiered, or the wrap plan. They're saying that everything else will go away. And then Parent Plus loans or ineligible consolidations, they're not going to be eligible for any IDR plan as far as we know, right? And like I said, this isn't official. Just to clarify, we're just giving you what we think might happen. Payment application is usually if you pay extra, you're going to pay charges like fees first, then interest, then it's applied towards principal. Rehabilitation, this is a very big thing to consider. If you have loans that are in default, they have had periods where getting out of default could be as easy as consolidating, if that's something that's available to you, or it could be as difficult as going through the motions. You got to give them all your income information, family information. They tell you what your payment's going to be. You have to make 9 monthly payments out of a 10-year period without missing any more than that one payment. Then your loans are brought out of default, and then you can get back onto a payment plan. Now, sometimes, like I said, you can just consolidate your loans and get out of default. The rehabilitation is more, they did this Fresh Start Initiative. I don't know if they have, I don't think they're offering it anymore, but Fresh Start Initiative lets you clear the hurdles during COVID. You didn't have to do the 9 payments out of 10 months. You just got basically almost snapped your fingers and you're out of default, and your loans were rehabilitated, meaning any negative remarks in your credit report were removed. So this is a consideration. Anytime you're trying to get your loans out of default, some methods will could potentially clear up your credit report. Some may not. So you have to, be aware of that and weigh the pros and cons and figure out what's best for you. Oh, we got some more questions. Do you have any more questions there, Jorge?
Yes, we do have 2 questions. One of them I kind of asked for clarification to get some context. And the question was, do we need to recertify our income if we are on the SAVE plan?
Oh, that's a loaded question. Well, you can't. So technically, the SAVE plan is in limbo. It doesn't really exist. They haven't officially gotten rid of it, so it's still sitting there as if it might be a plan. But what happens now, right? So if you're sitting on the SAVE plan, and what if you have to recertify tomorrow? Well, you can't recertify onto SAVE because that plan doesn't exist. So if you don't recertify, and we've seen this happen, they may just kick you out of the plan and move you to the standard 10-year plan. And then maybe you don't notice for 3 months and you log back on, and they say you have $9,000 past due. I would keep an eye on that. That's why I'm saying it's very important to know your IDR anniversary, and you have to make a decision, right? Do you want to sit there and run the risk of maybe they kick you off the SAVE plan and then you go into the standard plan that they determined for you? Or do you want to pick a plan for yourself, right? And if it were me, I would take action and try to find something better. Like I said, SAVE isn't counting right now. Yes, you can sit there and hope that you're going to be eligible for the buyback, but like one of our listeners just said, they've been waiting for almost a year now for the buyback. It's not happening yet. If you're in the buyback, also to that individual, can you respond? Are you making payments right now, or are you still just sitting there like you're just in forbearance making no payments?
All right, we got 2 more questions, but one of them is a kind of a follow-up on the SAVE plan question. So the question is, when will we be forced to move to another plan from SAVE?
That's another great question. So originally they said July 1st, 2028, everyone was going to be kicked off the SAVE plan. Recently, there's been a push to end the SAVE plan tomorrow, or as soon as possible. There's a push to just get rid of this plan once and for all. So the long story short is I have no idea. I don't see how this could be, how you could stay on it till July 1st, 2028 though, right? If you have to recertify in, let's say 3 months or 6 months or 9 months, I don't see, you can't stay on the plan. I don't know how they were trying to propose to keep it around till July 2028, right? So that's where you have to make a decision. You have to look at your income-driven repayment plan and see if it makes sense to just kind of to hold the line and wait, or do you want to start taking control of your own destiny?
Sorry, I couldn't find the unmute. There's one question here. One more. Does the Section 2206 of the CARES Act apply to private loans or just government?
That's a great question. I have not had that question before. I don't see why it wouldn't apply towards private loans. It just has to be paid towards your student loans as the language reads. I have a template, and that's one thing. If anyone is interested in adding this, like if you have a business, someone wants to add this or have their employer add it, the only requirements really are you have to have a written plan in place, and the owner can't derive more than 5% of the benefits. Employees have to be notified of the plan, and allowed to participate if they would like. I think it can be for any loans, just as long as it's paid to your loan servicer. That's a great question. I will look that one up.
There's one comment that I think we all agree with. So stressful, LOL. And the follow-up comment is, I am not making payments while waiting for the buyback. I did reach out twice and they said it was moved to review process. I think that is what they said.
Okay, so the other option is, what we've advised some people of this as well. If you're waiting, let's say if you went on, let's say the IBR 2014 plan and your payment was going to be $300 a month, and on save your payment would have only been, I don't know, $250 a month, right? You can either make payments right now at that $300 a month and just take control. Like, let's say you only have 6, 8, 10 months left, just make those payments. If at some point they come back and say, okay, you can make the payments on save, great. Then you go back and you make X amount of payments at 250 instead of 300, or 350, as long as it's not a huge difference, right? Even if it's, $200 versus $500, it's up to you to make the choice there. But would you rather make those payments and be done with it rather than just keep sitting around and waiting and then, who knows? So those are your options at that point. So yeah, if it's in review, I mean, I don't know what that means. I could pull up the last status report. I think it was only like 3,000 loans were totally discharged for PSLF last month, maybe. It's something like that. It's not a very large number. So last month, out of all the loans they discharged, every loan, loan forgiveness, not even just PSLF, I think every loan was on the IBR plan. There was none forgiven on ICR, none forgiven on pay as you earn. And this ties to the fact they were trying to get rid of those plans. The Department of Education claims their systems haven't been updated to allow forgiveness for those plans yet, and they're working on it. So that's where they're stuck right now. But that just goes to show that, they're backed up. They've got so many applications right now. Sorry.
I don't think we have any other pending questions right now. Keep
Okay.
them coming. If I see questions that come in, I'll make sure to bring them up. I don't see any in the Q&A.
Okay. Yeah, and I
I
know this
guess
is. Oh, go ahead. What were you gonna say?
I was gonna say at some point, I guess as we get closer to the end, if anybody wants to raise their hand, it's easier for them to, if I can bring them off mute at some point. As we get closer to the end, it might be easier to ask questions that way.
Yeah, we're almost done right here. Yeah, that's a great point. But yeah, so the public service loan forgiveness, the RAP plan should be, I'm gonna say should be a qualifying repayment plan for PSLF. ICR will only qualify through June 30th, 2028 is what they're saying right now. And let's see, consolidated loans. So there's another really important issue. So this is one they snuck in here, though. If we read this, direct consolidation loans made on or after July 1st, 2026 are eligible only for the tiered standard or WRAP plan. So you can't consolidate after July 1st this year and then say, okay, now I want to put my loans back on pay as you earn, right? Consolidating pre-2026 loans after that date reclassifies them as new post loans and ends IBR or pay eligibility. So they're saying right there that if this stuff all goes through, they will no longer be eligible. But it also specifies, this is super important. You need to know this, that this is especially true if you're not working towards PSLF, but the new direct consolidation loan shall be treated as having no qualifying payment history prior to the date of consolidation, except for certain legacy forgiveness programs like PSLF. They're saying that if, let's say you've been paying on your loans for 20 years, and then you consolidate after July 1st, they're saying, if I'm reading this right, your payment count will go back to zero. You were at 240 months and maybe only needed another 60 months of payments and your loans would be forgiven. You make the mistake of consolidating after July 1st because you didn't know, all of a sudden your payment count restarts. So that could be a huge costly mistake. They're saying it should not affect PSLF, but I would not even bother to consolidate. Now, why would you consolidate loans on PSLF? Well, you might have, let's say you have 10 different loans. They might have 10 different payment counts, right? Some might have 100 or 102, 104, 106, 108. If you consolidated in the past, before June 30th, 2024, you would have gotten, your consolidated loan would have gotten the highest payment count of any of the underlying loans, right? So if it was between 100 and 110 on those underlying loans, if you consolidated all into one loan, that payment count was 110 towards PSLF. So you just, shorten the amount of time you had to be on PSLF. However, if you did it after that date, it's kind of murky water. They're saying you're supposed to get the weighted average payment count. Okay, so maybe you consolidate, maybe it goes to 105. If you're going to run the risk of going to zero, I most likely would not even consolidate, right? I would just try to get get to forgiveness, just keep making your payments and maybe not even and do that, maybe not do that. After July 1st, that consolidation restarts the 30-year WRAP or IDR clock, except for PSLF is explicitly preserved. Now, I don't know what that's going to mean, but I wouldn't even mess with it. Mixed cohort, if you have some before and after, you get into what happens there. Parent Plus loans and certain consolidations that contain Parent Plus balances, they cannot use the WRAP or legacy IDR plans and must follow the tiered standard repayment plan. Pre-2026 loans, accepted loans retain their prior arrangements. So this is what I'm talking about. We've helped clients already consolidate. They did that double consolidation. They're on like the pay or IDR plan. We're hoping they can stay on it. If you consolidate now in 2026, I don't know. Is it going to, you're not eligible, or only if you do it after July 1st? We don't know. So yeah, it kind of gives you the different, this just kind of talks about all the overall changes. So yeah, you can open it up to, if anyone wants to jump on and ask questions. Keep in mind, I can't give you specific answers, to your specific situation, but I'll try to give you as much information as possible to make your own decision.
All right. Well, people have the opportunity to either raise their hand or ask questions. I wanted to make sure I read out the CLE code, and the CLE code is 2600230N. I'm going to drop it in the chat right now. You missed it, don't worry. It's going to go out via email as well. It's also going to be in the YouTube description. If you copy it, be careful not to copy the space, because sometimes that causes an error when you're posting the CLE credit. I also posted a link to the materials where you can find a copy of the slides that were used today. And I also want to take the opportunity to drop the contact information for Pat. There's his email and the Prudent Financial Planning website, where you can find more information on how to contact them and get a consultation. So let's see if we have any questions. I don't see any in the Q&A. Anybody that wants to raise their hand and come off, I can unmute you if it makes it a little bit easier to ask questions. Um, and one thing that I'll do, I'm gonna stop the recording. That way, if people want to speak up, they don't feel, this is gonna be in the recording. So before I do stop the recording, I want to thank Pat and Jailene for joining us today and leading this webinar. This is an area that it's extremely confusing and it just doesn't stop changing. Feels like the last year lasted like 5 years, not one, and it's been a lot of changes, really hard to keep track of. And I know for us, the legal aid attorneys and law students or even private attorneys who are considering joining nonprofits, the legal aid community, government, the public service loan forgiveness is a huge incentive. So this was really helpful on understanding the acting early and making sure we certify. I really enjoyed those examples. I was like, oh, how can I get my payment down to $70? That would be a dream, but I don't think I can contribute that much in my retirement. But it does present some interesting scenarios on how to really maximize income and make sure you pay the least amount possible, and maybe you're a few months away from public forgiveness, so maybe that's a good strategy to overtake. So with that said, I'm going to thank you both again and thank everybody for joining us. I'm going to stop the recording so we can start asking some questions. So